Pennsylvania's housing market looks on paper like a portrait of Rust Belt resilience. Statewide median prices pushing past $300,000. Inventory rising. Mortgage rates easing back towards 6%. On the surface, the Keystone State appears to be finding its footing after years of post-pandemic turbulence. But underneath that carefully maintained facade, something far more dangerous is already burning. A slow-moving fuse lit by decades of population hemorrhaging, industrial collapse, poverty entrenchment, and housing stocks so old and decayed that entire city blocks are rotting from within. The cracks are not subtle anymore. Sales volumes are falling. Days on market are stretching. Sellers are quietly slashing prices in neighborhoods where the demand that never fully arrived is now officially leaving. What follows are the 9 Pennsylvania cities most at risk of a home price crash as economic fragility, demographic decline, and structural rot converge in 2026. Number 9. Johnstown. On the surface, Johnstown tells a story of blue-collar grit and stubborn survival. Its hillside neighborhoods, Victorian architecture, and the famous incline plane that climbs 500 feet above the Conemaugh Valley give the city a postcard-worthy charm that locals defend fiercely. Recent data from Rocket Homes even shows a brief flash of median price activity in the $110,000 range in mid-2025, a figure some optimists pointed to as proof of a turnaround. Dig a little deeper and the numbers begin to corrode like the steel mills that left a generation ago. Johnstown's 2026 population has fallen to approximately 17,595, a staggering 25.3% collapse since the year 2000. The city is shrinking at a rate of roughly 0.73% every single year, with no demographic force strong enough to arrest the slide. The median household income sits at just $37,888. Nearly 32% of residents live below the poverty line, one of the highest poverty rates of any city in Pennsylvania. The median estimated home value in recent census data hovers around $44,000, placing it 84% below the national average. These are not the numbers of a market correcting. These are the numbers of a market that never fully recovered from the 1977 flood, the steel collapse of the 1980s, and the decades of disinvestment that followed. What makes Johnstown uniquely dangerous in 2026 is the absence of any structural demand driver. There is no major university anchor. There's no technology employer establishing a footprint. There is no remote worker migration story. The local economy depends almost entirely on healthcare and retail, 2 sectors that cannot generate the kind of household formation needed to absorb even the modest inventory that comes onto the market. Cambria County issued building permits for barely 0.7% more housing units between 2017 and 2023, reflecting a market so moribund that builders refuse to bet on it. When 42% of homes in any given month are selling below asking price, and listing ages have climbed more than 30% year over year, the mathematics of decline are impossible to deny. In Johnstown, the crash is not coming. It has been arriving slowly, block by block, for 40 years, and 2026 is simply the next brutal chapter. Number 8. Altoona. Altoona presents itself as a mid-sized Pennsylvania city with a proud railroad heritage, an affordable cost of living, and the stable, if unspectacular, job base, anchored by healthcare providers and retail. It consistently ranks among the cheapest places to live in Pennsylvania, a badge of honor that masks a more alarming economic reality hiding just beneath the welcome signs. In reality, Altoona is a pressure cooker of compounding vulnerabilities. The city's overall crime rate stands 3% above the national average, a figure that discourages the young professional demographic cities in decline desperately need. Non-farm employment growth is under 1% annually, so sluggish that the local economy is effectively standing still, while inflation silently erodes purchasing power. The economy's heavy reliance on healthcare, retail, and manufacturing creates a single point of failure employment base. If a major healthcare system restructures or a manufacturing facility closes, the ripple effect on housing demand would be immediate and severe. Altoona is essentially 2 hours from Pittsburgh and functionally isolated from any major growth corridor, stranding its residents in an economic island with limited connectivity to the state's thriving urban labor markets. Blair County, which encompasses Altoona, has seen its housing stock age into obsolescence. The Pennsylvania Association of Realtors noted in early 2025 that a full quarter of occupied housing units statewide were built before 1940, and older industrial cities like Altoona skew far worse than that average. Deferred maintenance costs on aging inventory are climbing, and buyers increasingly balk at the capital expenditure required to bring decades-old properties up to modern, livable standards. The Pew Charitable Trust's 2025 report on Pennsylvania housing underscored that regions issuing the fewest building permits, and Blair County is firmly in that cohort, saw the economic degradation that comes not from a crash, but from a slow, suffocating contraction. In 2026, as rising inventory statewide gives buyers more choices and less urgency, Altoona's structurally weak demand base leaves it exposed, one corporate departure away from a price spiral that a city with a shrinking tax base and an aging population cannot survive. Number 7. Sharon. Sharon sits in Mercer County in the far northwest corner of Pennsylvania, close to the Ohio border, and it wears its Rust Belt scars openly. At first glance, its low home prices, some properties trading for well under $80,000, attract out-of-state buyers hunting for yield and affordability in a market where coastal cities have priced out entire generations. The narrative of Sharon as a hidden gem, a diamond in the rough waiting to be polished by some future economic revival, is a story some real estate investors have been telling themselves for 2 decades. Beneath the surface, Sharon is experiencing the kind of structural unraveling that creates not opportunities, but traps. The city's population has declined dramatically since its peak industrial era, and Mercer County's broader labor market has never replaced the manufacturing jobs that evaporated when the steel and metalworking industries collapsed in the late 20th century. Household incomes remain well below state averages, with significant portions of the local population dependent on fixed incomes or government transfer payments, neither of which creates organic housing demand. The local commercial district bears the physical marks of disinvestment, vacant storefronts, deteriorated infrastructure, and a built environment that signals risk rather than opportunity to incoming buyers and investors. What makes Sharon particularly vulnerable in 2026 is its near-total dependence on a single economic axis, the regional healthcare and light manufacturing sector, that is itself under pressure from consolidation trends sweeping smaller market providers nationwide. When anchor employers leave or downsize in a city of Sharon's size, the multiplier effect on housing demand is devastating and swift. With no meaningful population growth story, no technology or remote work pipeline, and property tax burdens that outpace the value they are meant to support, Sharon's housing market is balanced on a knife's edge. A small increase in mortgage defaults, a single major employer exit, or continued outmigration of working-age residents could trigger a price compression that turns already low valuations into something far grimmer. A market where homes simply stop selling at any price. Number 6. Hazleton. Hazleton looks briefly like a success story. Located in Luzerne County in northeastern Pennsylvania, the city received significant media attention in the 2000s for its controversial immigration enforcement ordinances. But more recently, it has been recast as a warehouse and logistics hub, attracting distribution center investment along the Interstate 81 corridor. Amazon, Chewy, and other e-commerce giants have planted flags in the surrounding area, and for a moment, the city appeared to be threading the needle between its coal country past and the logistics-driven future. The fragility of that narrative is becoming impossible to ignore. Hazleton's core residential market is burdened by structural affordability mismatches that are only deepening in 2026. Luzerne County issued building permits for just 1.5% more housing units between 2017 and 2023, among the lowest rates in the state. Yet rents climbed 71% during that same period, according to the Pew Charitable Trust 2025 analysis. That rent explosion does not translate into home price stability. It translates into severe rent burden, with workers priced out of both renting and ownership, while wages in warehouse logistics, typically starting between $15 and $20 per hour, remain structurally insufficient to support homeownership at 2026 price levels. The dream of a warehouse-driven housing renaissance is colliding headfirst with the mathematics of affordability. Distribution center jobs do not generate the disposable income necessary to sustain home purchases, and the workers who fill those roles are largely renters by necessity, not choice. Meanwhile, the city's poverty infrastructure, elevated crime, aging schools, fiscal stress on municipal services continues to deter the middle-class homebuyer migration that could stabilize values. When the logistics boom eventually cycles through its inevitable warehouse oversupply correction, Hazleton will be left holding a housing market built on an employment base that never had the earning power to sustain it. Number 5. Reading. Reading has been celebrated in recent years as an unlikely comeback story. Located in Berks County, it sits within commuting range of Philadelphia and the Lehigh Valley, and some forecasters in 2024 projected meaningful price appreciation for the metro area. The city's population, swelled by a large and growing Latino community, appeared to provide the demographic fuel needed to reverse decades of decline. In certain zip codes and on certain spreadsheets, Reading looked like a city finally turning the corner. Beneath the optimism lies a structural foundation riddled with fault lines. Reading consistently ranks among the poorest cities in America for its size, with poverty rates hovering between 35% and 40% depending on the measure used, among the highest of any mid-sized American city. The median household income remains deeply depressed relative to the surrounding county, creating a bifurcated market where Berks County's suburbs grow while the city core stagnates and erodes. The housing stock is aging catastrophically. Philadelphia and Schuylkill counties have the oldest housing in Pennsylvania, with median construction years of 1949 and 1944 respectively. And Reading's urban core falls squarely within that aging inventory band. Homes built in the 1920s and 1930s, with decades of deferred maintenance, are not investment opportunities. They are liability generators, requiring $40,000 to $80,000 in rehabilitation work before they can be made safely habitable. The gap between purchase price and true cost of ownership is a trap that catches first-time buyers and out-of-state investors alike. In January 2026, statewide data from Redfin showed that 22.5% of Pennsylvania homes had price reductions, and in economically distressed cities like Reading, that figure runs dramatically higher. A city with 40% poverty, an aging housing stock, and a local economy that cannot generate the incomes necessary to support even modest home ownership is not a comeback story. It is a slow-motion collapse dressed in hopeful language. Number 4. Wilkes-Barre. Wilkes-Barre carries the surface appearance of a resilient northeastern Pennsylvania city, a county seat, a regional commercial hub, the home of Wilkes University and King's College, surrounded by the urban sprawl of the greater Scranton metro that has attracted remote workers and transplants looking for affordable alternatives to the New York tri-state area. In October 2025, Redfin showed median home prices in Wilkes-Barre at $184,000, with modest year-over-year gains. The narrative of a stable, affordable market finding its footing appears plausible. The deeper architecture of Wilkes-Barre's vulnerability is sobering. The Pew Charitable Trust's 2025 report revealed that in Luzerne County, Wilkes-Barre's home, 58% of renters were considered rent-burdened in 2023, a dramatic deterioration from 48% in 2017. More alarmingly, 38% of Luzerne County renters were severely burdened, spending more than half their income on housing. This is not the profile of a healthy, demand-driven market. It is the profile of a market where prices have outrun the economic capacity of the population they are supposed to serve. A tension that, when it releases violently. The city's housing stock growth from 2017 to 2023 represented barely 1.5% of existing supply, one of the lowest rates in Pennsylvania. Yet rents climbed 71%, creating a false floor of apparent value that masks genuine unaffordability. The volume of home sales in Wilkes-Barre in October 2025 was already down from 42 to just 31 transactions, a 26% year-over-year decline, signaling that buyers are stepping back even as headline prices hold. When transaction volume collapses before price follows, the market is sending a warning that superficial metrics refuse to register. In 2026, as mortgage rates sustain above 6% and economic pressure on working-class households intensifies, that warning will translate into something unmistakable on the price line. Number 3. Chester. Chester, Delaware County, sits just 15 miles south of Philadelphia's center city along the I-95 corridor, and therein lies the cruelest irony of its housing situation. In a metropolitan area where median home values exceed $400,000 and suburban demand remains ferocious, Chester occupies a geographic position that should, by any logic of proximity, translate into strong housing demand and rising values. By early 2025, certain sources reported a median sale price around $120,000 for the city, a figure so disconnected from its suburban neighbors that it functions less as a market indicator than as a symptom of systemic collapse. Chester is a city that has been in managed decline for decades, and no amount of geographic luck can paper over structural devastation at this scale. The city carries one of the highest poverty rates in Pennsylvania, with decades of industrial disinvestment that followed the closure of shipyards and manufacturing plants that once employed tens of thousands. The school district has been in a state of near-permanent financial crisis. Municipal services operate under severe fiscal strain, with the city spending years under state oversight for financial distress. Property vacancy and blight are not fringe concerns in Chester. They are dominant features of entire neighborhoods, dragging down comps, suppressing appraised values, and creating a negative feedback loop where declining values produce less tax revenue, which produces worse services, which produces more departures, which produces further price erosion. The Delaware County suburbs immediately surrounding Chester are experiencing rent increases and housing price appreciation that Chester itself cannot access because the barriers to investment, crime, blight, fiscal instability, school quality, remain structurally entrenched. In 2026, Chester is a market where even $120,000 represents a price that may not hold because the demand capable of sustaining it is simply not there, and it will not be there until the structural rot is addressed at a scale and cost that no current investment pipeline is prepared to deliver. Number 2. Erie. Erie is Pennsylvania's fourth largest city, a port city on the shores of Lake Erie in the state's northwest corner, and it carries the trappings of a mid-sized regional hub, a lakefront, a convention center, Mercyhurst University, and a manufacturing base that survived the worst of the deindustrialization waves that devastated its neighbors. In recent years, modest price appreciation and a low cost of living have attracted attention from value investors and remote workers seeking a waterfront city at a fraction of coastal prices. Erie, on the surface, looks like exactly the kind of undervalued, overlooked market that smart money discovers before the crowns arrive. In reality, Erie is a slow-burning fuse attached to a housing market with almost no structural fireproofing. Erie County issued building permits for just 1.3% more housing units between 2017 and 2023, among the very lowest rates in Pennsylvania, and even that minimal investment has not translated into price stability. Rents climbed 40% over that same period, while wages grew at far slower rates, deepening an affordability squeeze that leaves residents both unable to own and increasingly strained as renters. Erie's population has been declining for decades, with younger residents and working-age families migrating toward Pittsburgh, Cleveland, or Buffalo in search of better employment ecosystems. The industrial base, while not gone, remains heavily concentrated in legacy manufacturing sectors vulnerable to tariff disruptions, automation pressures, and global supply chain realignments accelerating in 2025 and 2026. When statewide data from Realtor.com showed delistings surging 45.5% year over year through October 2025, the highest rate since tracking began, Erie sellers represented a disproportionate share of that retreat, reflecting a market where confidence in achievable prices is genuinely cracking. As of 2025, housing inventory in Erie is rising faster than in most comparable Pennsylvania markets, a warning signal that supply is outpacing whatever demand remains. A city simultaneously losing population, losing young workers, carrying a fiscally stretched municipal government, and sitting far from Pennsylvania's economic growth corridors does not correct. It crumbles, and in 2026, the crumbling is accelerating. Number 1. DuBois. DuBois sits in Clearfield County in west central Pennsylvania, and it presents as a quiet, self-sufficient small city, a regional service center for the surrounding rural communities, home to Penn Highlands DuBois Hospital, a small Penn State campus extension, and the kind of tight-knit community identity that outsiders find charming and locals find sufficient. The housing market here appears, at baseline, unremarkable rather than alarming. Modest prices, modest inventory, modest activity. Nothing in the surface data triggers an obvious alarm, but the forecast data does. DuBois was explicitly named among the Pennsylvania cities predicted to experience considerable price declines going into 2025 and 2026, alongside Johnstown and Altoona, by analysts at Norada Real Estate Investments in their October 2024 forecast. That is not a coincidence. The structural profile of DuBois is a near-perfect assembly of every vulnerability that turns modest housing markets into genuine collapses. Clearfield County has been losing population for years, with the outmigration of working-age residents accelerating as the regional energy and timber economies, already in long-term contraction, continue shedding jobs. The county's economic base lacks the diversification necessary to cushion against sectoral shocks. Penn Highlands DuBois, as the largest employer in the area, represents a near-total single point of failure. Any consolidation, merger, or restructuring in the regional healthcare landscape would immediately translate into layoffs that the local housing market has no buffer to absorb. Building permit issuance in Clearfield County has been essentially negligible for years, not because demand is strong enough to preclude new supply, but because the demand simply does not exist to justify new construction investment. The homes being sold in DuBois are predominantly aging stock, many built before 1960, requiring capital expenditures that buyers in a low-income, aging population market cannot finance. The median household income in the broader region sits well below state averages. Poverty rates are elevated. Young residents leave as soon as viable alternatives present themselves, and those alternatives, college towns, Pittsburgh suburbs, out-of-state metros, become more accessible with every remote work tool and every Greyhound ticket purchased. When a market's only price support is the absence of alternatives, when people are staying not because they choose to, but because they have nowhere else to go, that is not stability. That is a powder keg waiting for the moment the last reason to stay quietly disappears.